Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Lennar Corporation quarterly report. Lennar Corporation offers a wide range of businesses and services to cater to various needs of its customers. At the core of its operations are homebuilding activities, which include constructing and selling single-family attached and detached homes, as well as purchasing, developing, and selling residential land. The company also develops, constructs, and manages multifamily rental properties. In addition to homebuilding, Lennar provides various services that support the homebuying process. These include residential mortgage financing, title insurance, and closing services for home buyers and others. Furthermore, the company originates and sells securitization commercial mortgage loans, providing financial solutions to its customers. Lennar's business also extends to fund investment activities, allowing it to diversify its revenue streams. With a presence in various regions across the United States, the company primarily serves first-time, move-up, active adult, and luxury homebuyers. Its extensive range of services makes Lennar a one-stop shop for customers seeking comprehensive solutions for their housing needs. The company's diverse portfolio includes homebuilding operations, residential mortgage financing, title insurance and closing services, multifamily rental property development and management securitization, commercial mortgage loans, fund investment activities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for Lennar Corporation can be identified through an analysis of its various business segments. Revenue growth is primarily driven by the homebuilding segment, which saw a significant increase in finished homes and construction in progress from 2025 to 2026. Additionally, financial services revenue also contributed to growth, with mortgage financing, title and closing services, and sales of property and casualty insurance generating substantial income. On the other hand, revenue decline was observed in several segments, including homebuilding, which experienced a decrease in sales of homes in the East region and land in the Central region. Financial services revenue also declined due to lower lock volume and profit per locked loan. Multifamily revenue suffered from decreased gross margins in both the East and Central segments. The company's performance varied across different regions, with the South segment experiencing a 0.5% increase in revenue, while the East, Central, West, and other segments saw declines ranging from -8.4% to -33.8%. The decline in deliveries and sales price was also notable in several segments, particularly the East and West segments. Overall, Lennar Corporation's revenue growth or decline is influenced by a combination of factors, including changes in homebuilding activity, financial services performance, and multifamily operations across different regions. The company's net income and profit margins underwent significant changes between 2025 and 2026. Net income decreased by a substantial 56%, from $519 million in 2025 to $229 million in 2026. This decline was accompanied by a decrease in profit margins across various segments. In the homebuilding segment, profit margins dropped from 10.1% in 2025 to 4.7% in 2026, while the financial services segment saw its margins decrease from 46.2% to 57.3%. However, the multifamily segment experienced an increase in profit margins, rising from 15.8% to 20.1%. The reasons behind these changes are attributed to several factors. A decline in average sales prices of homes delivered and higher land costs contributed to the decrease in net income and profit margins. Additionally, lower revenue per square foot and reduced leverage due to lower revenues further exacerbated the situation. The company was also forced to offer incentives to stimulate sales, which currently stand at 14%. These challenges highlight the need for the company to adapt its strategies and address these underlying issues to improve its financial performance. The company's financial performance reveals a significant improvement in its operating cash flow. On page 1 of the report, we see that the net cash provided by operating activities is a substantial $1,654,330,000. This indicates a strong ability to generate cash from its core operations. However, upon closer inspection, there are some discrepancies in the data. On page 39, it appears that the company used $434 million in operating activities for the year 2026, which would suggest a negative operating cash flow. However, this number seems to be an error given the context of the report. Fortunately, on page 40, we find that the net operating cash flow is indeed positive, with a difference of $105 million being less than $340 million. This confirms that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and ability to sustain its operations. The company's debt level and interest expenses have undergone significant changes over the past year. On one hand, there are decreases in total debt, residential facilities debt, multifamily investments in unconsolidated entities, and total liabilities. For instance, total debt decreased by $1.22 billion, while residential facilities debt dropped by $644.9 million. Additionally, interest expenses saw a notable decrease from $23.2 million to $19.9 million. However, there are also increases in certain areas. Homebuilding debt increased significantly, rising by $1.85 billion. Furthermore, homebuilding average debt outstanding experienced an 83% increase, jumping from $2,236,667 to $4,077,292. Interest incurred also saw a substantial rise of 73%, increasing from $31,489 in 2025 to $54,575 in 2026. These mixed trends suggest that the company's financial situation is complex and multifaceted. While some areas show improvement, others indicate increased financial burdens. A closer examination of these changes would be necessary to fully understand their implications for the company's overall financial health. The performance of various segments within the company has been analyzed, revealing both strong and weak areas. In terms of well-performing segments, the homebuilding segment in the East and Central regions showed notable results. Additionally, the financial services sector demonstrated impressive financials, with $2.808 billion in total assets and $1.39 million in total liabilities. The multifamily segment also performed well, boasting $842 million in total assets. On the other hand, some segments struggled to meet expectations. The homebuilding segment in the South Central and West regions underperformed. Furthermore, the Lennar Other segment had a relatively low total asset value of $829 million and minimal liabilities of $95 million. Management is optimistic about the company's outlook, citing a positive market trend, with projected average selling prices ranging from $166,000 to $310,000. The company has a vertically integrated platform and is investing in long-term multifamily development investment vehicles to develop Class A assets. However, management acknowledges potential challenges in managing certain assets, which may impact the company's results. Despite these challenges, management remains focused on its strategy of developing a geographically diversified portfolio of institutional quality, multifamily rental properties. The company has a clear plan to drive volume and refine its asset-light manufacturing platform, with expectations for new orders to reach 21,000 to 22,000 homes in Q2 2026. Management is also exploring transactions to manage leverage and liquidity, take advantage of market opportunities, and increase revenues and earnings. A strategic commitment from TPG of $1 billion will support the company's pipeline opportunities and accelerate its development pipeline. Overall, management's strategy appears to be centered on diversifying the portfolio, investing in long-term assets, and managing risk through strategic transactions. The company has made several strategic moves through acquisitions and divestitures to expand its business and optimize its portfolio. In terms of acquisitions, the company has invested in 5 Point, a significant move that demonstrates its commitment to growth. Additionally, it has made an investment of $78.1 million in Upward America Venture LP, further diversifying its interests. The company has also purchased land from 3 land banks for $2.8 billion, providing a substantial boost to its assets. On the other hand, the company has engaged in divestitures to streamline its operations and focus on core areas of business. Specifically, it has sold off joint ventures rental operation projects and investments in various rental projects, allowing it to concentrate on more profitable endeavors. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which it has done consistently. In fact, as per the records, the company paid out a quarterly cash dividend of $0.50 per share on both Class A and Class B common stock in May 2026. In addition to paying dividends, the company has also been actively involved in buying back its own shares. This is evident from the information that it repurchased a significant number of shares in the 3 months leading up to February 28, 2026. The exact numbers are impressive, with the company purchasing 1,836,885 shares of Class A common stock and 163,115 shares of Class B common stock during this period. These actions demonstrate the company's commitment to its shareholders and its desire to return value to them through various means. By paying dividends and buying back shares, the company is able to reward its investors and also reduce the number of outstanding shares in circulation, which can have a positive impact on the share price. There are concerns about inventory buildup and supply chain disruptions that have been observed in various pages of the extracted summaries. In terms of inventory buildup, there has been a significant increase in the amount of inventory owned by $554 million between February 28, 2026 and November 30, 2025. Additionally, inventories have increased by -652,015 units in 2026 compared to -513,257 units in 2025. Furthermore, the total value of inventory buildup has reached $12,122,063,000 and $11,841,255,000 on different pages. It is also noted that finished homes and construction in progress are included within inventories, indicating a potential for overstocking. Moreover, land under option with third parties worth $1 billion as of February 28, 2026, suggests an increase in inventory due to land purchases. Regarding supply chain disruptions, there have been reports of supply shortages and increased costs related to construction materials and labor. The statement, "Supply continues to fall short of need," on page 33 highlights the severity of the issue. Additionally, a decrease in total dollar value of new orders and average sales price has been observed, indicating a potential decline in demand. The combination of inventory buildup and supply chain disruptions is also evident, with an increase in inventories due to land purchases and construction costs. Net payments from liabilities related to consolidated inventory, not owned due to activity with land banks, have also been noted, suggesting a complex relationship between inventory management and supply chain issues. That concludes the financial summary for Lennar Corporation. Feel free to comment below, and I will be happy to answer them when possible.